What if I told you that free money your employer gives you, your 401k match, is not just a bonus, but perhaps the single most potent weapon in your arsenal for financial freedom? Most people glance at their match, think nice extra, and move on. But they're missing the bigger picture entirely. They're leaving a golden ticket on the table, a direct, accelerated path to not just retirement, but to genuine financial independence years, even decades, sooner than they ever thought possible. Get ready, because what you think you know about your 401k match is about to be completely rewritten. This isn't hyperbole, it's a profound financial truth. Your 401k match acts as an incredible accelerator for your wealth building. It's like adding rocket fuel to your savings, instantly boosting your contributions and putting you on a faster trajectory towards your retirement goals. We're talking about more than just incremental growth. We're talking about a fundamental shift in how quickly your nest egg accumulates. This accelerated growth is crucial, especially when we start talking about a specific strategy that can liberate you from the daily grind much, much earlier. Here's the harsh reality: a staggering number of employees fail to contribute enough to their 401k to even receive their employer's full match. Think about that for a second. Companies are offering free money, literally handing over additional funds to boost your retirement, and millions are just leaving it on the table. It's like turning down a pay raise you've already earned. Why does this happen? Often, it's a mix of misunderstanding, underestimation, or simply not prioritizing this critical benefit. But the cost of this oversight is truly astronomical over a lifetime. When your employer offers a match, say 50 cents on the dollar up to 6% of your salary, that's an immediate, guaranteed 50% return on your contribution. Where else can you get that kind of instant gratification in the investment world? Not the stock market, not real estate, nowhere reliably. This isn't just growth, it's an immediate boost to your capital before any market returns even kick in. Understanding this immediate, tangible return on investment is the first step to truly valuing your match and leveraging it to its full potential. Let's quickly define what we're talking about. A 401k match is simply a contribution your employer makes to your retirement account, based on the amount you contribute. It's an incentive to save for retirement. The most common structures are dollar for dollar up to a certain percentage of your salary, e.g., 100% up to 3%, or 50 cents on the dollar up to a higher percentage, e.g., 50% up to 6%. This free money is vested over time, meaning it's truly yours after a certain period, reinforcing that it's a long-term benefit designed to keep you saving and invested. Why do companies offer this incredible benefit? It's not purely altruism. While it certainly helps employees, it's also a powerful tool for attracting and retaining talent. In a competitive job market, a robust 401k match can be a significant differentiator. It also demonstrates a commitment to employee well-being, fostering loyalty, and reducing turnover. From a business perspective, it's a savvy investment in their human capital. But for you, the employee, it's a direct, measurable addition to your compensation that many simply aren't maximizing. Let's quantify the hidden cost. Imagine an employee earning $60,000 a year, with a company offering a 50% match up to 6% of salary. To get the full match, they need to contribute 6%, $3,600. The company then contributes an additional 3%, $1,800. If this employee only contributes 3%, $1,800, they miss out on half the match, which is $900 annually. Over 30 years, assuming a modest 7% return, that missed $900 per year could easily amount to over $100,000 in lost retirement savings. That's a significant chunk of your financial freedom vanishing. This lost potential highlights the true magic of compounding. Albert Einstein famously called compound interest the eighth wonder of the world. Each dollar your employer contributes, and each dollar you contribute, starts earning returns, and then those returns start earning returns. This exponential growth transforms small, consistent contributions into massive wealth over time. The earlier you maximize that match, the longer those free dollars have to compound, creating a snowball effect that is almost impossible to catch up with later in life. Let's look at Sarah. At 25, she started her first job, earning $50,000. Her company offered a 100% match up to 3%. Sarah contributed the full 3%, $1,500, and immediately received another $1,500 from her employer. She wisely invested in a low-cost S&P 500 index fund. If she consistently contributed and received that match, by age 65, those early matched contributions, compounding over 40 years, would represent a significant portion of her total nest egg. Her initial $1,500 free money would grow into a fortune, all thanks to early, consistent action. Now, consider John. Same salary, same match, but John thought he couldn't afford to contribute 3% in his early years. He waited until 35 to start maximizing his match. That's a 10-year delay. While he still accumulated wealth, he missed out on 10 years of that initial $1,500 employer contribution compounding. Even if John contributed more later, the power of those lost early years is almost impossible to recover. This stark difference highlights that the true cost of not maximizing your match isn't just the missed immediate dollars, it's the lost decades of exponential growth. So, we've established the immense power of the 401k match, especially with compounding. But what's the ultimate goal here? Is it just having enough for retirement, whatever that means? Or is there a more concrete, empowering objective? For many, the true north isn't just comfortable retirement, it's financial independence, the ability to live off your investments without ever needing a job again. This is where the 401k match truly shines, acting as the fastest possible path to a specific, life-changing financial milestone. This milestone has a name, and it's called the 4% rule. The 4% rule is not just a guideline, it's a foundational principle of financial independence. It provides a blueprint, a clear actionable target for your retirement savings. In simple terms, it suggests that you can safely withdraw 4% of your investment portfolio each year, adjusted for inflation, and have a very high probability of never running out of money, typically over a 30-year retirement period. This isn't a magic trick, it's a meticulously researched strategy based on decades of market data. It gives you the target number for your nest egg, allowing you to plan with precision. This isn't just some arbitrary number plucked from thin air. The 4% rule originated from groundbreaking research, most notably the Trinity study published by 3 finance professors at Trinity University in 1998. They analyzed historical market data, specifically stock and bond returns, over various periods to determine sustainable withdrawal rates. Their findings, and subsequent updates, showed that a 4% initial withdrawal rate, adjusted annually for inflation, offered a very high success rate, over 95% in many scenarios, for portfolios lasting 30 years or more. This robust evidence makes it a cornerstone of retirement planning. So, a safe withdrawal rate, SWR, means the percentage of your portfolio you can draw down each year without depleting your principal. It balances your spending needs with your portfolio's ability to grow and withstand market fluctuations. The 4% rule factors in inflation, market volatility, and the historical performance of diversified portfolios. It's not about spending 4% of your remaining balance every year, it's 4% of your initial balance, adjusted for inflation. This allows for a consistent income stream, giving you peace of mind and predictability in retirement. Here's where it gets truly empowering. The 4% rule tells you exactly how much money you need in your investment portfolio to retire. If you want to spend $40,000 per year in retirement, you multiply that by 25, because 4% is 1/25 of your portfolio. So, $40,000 x 25 equals $1 million. That's your target. If you want $60,000 per year, you need $1,500,000. It transforms a vague "I need to save for retirement" into a concrete, measurable goal. This clear target is your North Star on the journey to financial independence. Let's break it down further. Suppose you've accumulated $1 million. In your first year of retirement, you withdraw $40,000. The remaining $960,000 stays invested and continues to grow. In subsequent years, you adjust that $40,000 withdrawal for inflation. So if inflation is 3%, you'd withdraw $41,200 in year 2. Your portfolio doesn't need to stay at $1 million, it fluctuates with the market, but the beauty of the 4% rule is its robustness, allowing your portfolio to recover from downturns and continue generating income for decades. It's about long-term sustainability. To truly appreciate the 401k match, let's consider what it takes to reach that $1.5 million target for $60,000 a year. If you only save your own money, it takes significant discipline and time. But every dollar of employer match is a dollar you didn't have to earn, and didn't have to save from your paycheck. It's an instant addition to your principal, which then begins to compound. This means you reach your target much, much faster. The math is simple, but the implications are profound for your timeline to financial independence. Here's the critical connection: your 401k match isn't just a nice-to-have benefit, it's a direct, measurable shortcut to hitting your 4% rule target. If your goal is $1.5 million, and your employer contributes $1,800 annually, as in our earlier example, that $1,800 isn't just $1,800. It's $1,800 that immediately starts compounding, effectively reducing the amount you need to contribute from your own earnings to reach that $1.5 million. It's not just saving money, it's saving time and reaching your ultimate financial freedom. Imagine your savings journey as a car race. Your personal contributions are the engine. Your employer match? That's the turbo boost button. It doesn't just add to your fuel, it increases your overall speed, getting you to the finish line faster. For someone with a 50% match up to 6%, their money is effectively growing 50% faster from the outset. This acceleration means you hit your 4% rule target years earlier, translating directly into more years of potential financial independence, where work becomes an option, not a necessity. Let's crunch some numbers. A hypothetical individual, earning $70,000, contributing 10%, $7,000, and receiving a 50% match up to 6%, $2,100. That's a total of $9,100 annually. Without the match, they'd only be saving $7,000. Assuming a 7% annual return, reaching a $1.5 million goal, with the match, it could take approximately 26 years. Without the match, it could take 30 years or more. That's a 4-year difference, 4 years of your life where you could be financially independent. The match drastically shrinks your timeline to freedom. The biggest misconception is viewing the 401k match as merely free money, something extra, a bonus. This mindset prevents people from prioritizing it. It's not extra, it's fundamental. It's a foundational pillar of your financial strategy. If you're not maximizing your match, you're essentially choosing to save for retirement at a much slower pace than necessary, actively delaying your financial independence. Change your perspective: this isn't a perk, it's a critical component of your compensation and your future. Every dollar of match you receive today is significantly more valuable than a dollar of match received 5 or 10 years from now. Why? The time value of money, fueled by compounding. That early dollar has more years to grow exponentially. It might double, triple, or even more, before a later dollar even gets started. So, if you're not maximizing your match now, you're not just losing $1,000, you're losing the potential for that $1,000 to become $10,000 or $20,000 in your future nest egg. The urgency to capture it now cannot be overstated. Of course, all these projections rely on market growth. The 4% rule, and the power of compounding, are built on the assumption of reasonable, long-term market returns. Historically, diversified portfolios of stocks and bonds have delivered average annual returns of 7 to 10% over many decades, even accounting for downturns. While past performance is no guarantee of future results, the strategy assumes you're invested wisely, typically in broad market index funds, allowing your matched contributions to ride the wave of economic growth over the long haul. Let's be real, markets aren't a straight line up. There will be volatility, downturns, and periods of slower growth. The 4% rule inherently accounts for these realities. The simulations from the Trinity study ran portfolios through the Great Depression, the dot-com bust, and multiple other crises. It's designed to be robust. However, understanding that your portfolio will fluctuate is key to staying the course. Don't panic sell during a dip. That's when you undermine the very power of compounding and the long-term strategy that your employer match is built upon. Decades after its initial publication, the core tenets of the Trinity study continue to hold strong. While some have debated minor adjustments based on current economic environments or longer retirement periods, the 4% rule remains a powerful benchmark. Its success isn't predicated on perpetual bull markets, but on the long-term resilience and growth of diversified investments. This historical backing should give you immense confidence that by diligently maximizing your 401k match and adhering to a sound investment strategy, you are building a future with a very high probability of success. So, what's the core mistake most people make regarding their 401k match? It's fundamentally underestimating its power and its direct link to their financial freedom. They see it as a small percentage, a minor boost, rather than the exponential engine it truly is. This underestimation leads to apathy, to not contributing enough, and ultimately, to delaying the life they truly want. The match isn't just a part of your benefits package, it's a direct down payment on your future self, an investment that pays dividends in both dollars and years of freedom. The most egregious mistake, as we touched on earlier, is failing to contribute at least the percentage required to get the full employer match. If your company matches 50% up to 6%, and you only contribute 3%, you're giving up half the free money. It's astonishing how many people do this, often because they simply don't review their plan documents or understand the specific terms. Always contribute at least enough to get the maximum employer match. It's literally the highest guaranteed return you can get on your money. Why do people hesitate to maximize their match? Often, it's a fear factor. Fear of not having enough cash flow today, fear of commitment, or simply feeling overwhelmed by financial jargon. They see the contribution come out of their paycheck and feel a squeeze now, without adequately visualizing the massive payoff later. But remember that instant 50% or 100% return. Think of it as pre-investing a portion of your income that immediately earns a massive return, rather than just losing money from your paycheck. Shifting this mindset is crucial. Even if maxing out your 401k feels daunting, remember the power of consistency. Start by contributing just enough to get the full match. If that's 6% of your salary, start there. Then, aim to increase your contribution by 1% each year, especially when you get a raise. These small, incremental increases, combined with the power of your employer match and compounding, will snowball into a significant retirement fund. It's not about huge, painful sacrifices, it's about smart, consistent, and intentional action over time. While the employer match is undeniably powerful, don't forget that your own contributions are equally vital. Once you've secured the full match, aim to increase your personal contribution as much as possible, ideally up to the IRS limits, $23,000 for 2024, or $30,500 if you're 50 plus. Every dollar you contribute, combined with your employer's match, gets that instant boost and then compounds for your future. The match is the foundation, but your continued savings are the walls and roof of your financial independence house. For those truly inspired by financial freedom, the 401k match and the 4% rule become synergistic tools for early retirement. Imagine reaching that $1.5 million target not at 65, but at 55, or even 45. That's a decade or two of life where you choose how to spend your time, whether pursuing passions, starting a new venture, or simply enjoying leisure. Your employer match isn't just funding a traditional retirement, it's accelerating your journey to a life where work is optional, and your time is truly your own. The true cost of inaction isn't just lost dollars, it's delayed freedom. Every year you don't maximize your 401k match is a year you potentially push back your financial independence date. If our earlier example showed a 4-year difference, what if you consistently missed the match for 10 years? That could add a decade to your working life. This isn't about scaring you, it's about empowering you with the knowledge that your actions today have profound consequences for your future timeline and quality of life. So, what's your clear path forward? First, find out your exact 401k match policy. Second, adjust your contributions to ensure you're getting every single dollar of that match. Third, if you can, increase your contributions beyond the match, aiming for the IRS maximums. Fourth, ensure your investments are in low-cost, diversified index funds. And fifth, resist the urge to panic during market downturns. These simple, actionable steps will put you squarely on the fast track to your financial independence, powered by your employer's generosity. Don't just set it and forget it. Make it a habit to review your 401k contributions and investment allocations at least once a year, or whenever you get a raise or change jobs. This ensures you're always maximizing your employer match and staying aligned with your financial goals. Your company's match policy might change, your salary will hopefully increase, and your financial goals might evolve. Regular checkups are like tuning up your car, they keep your financial engine running smoothly and efficiently towards your destination. The most empowering truth about your 401k match and the 4% rule is that you have far more control over your financial destiny than you might realize. This isn't about luck or hitting the lottery, it's about understanding powerful financial principles and taking consistent, intelligent action. Your employer has already set the stage by offering you free money. It's up to you to accept that gift, maximize its potential, and use it as a powerful lever to pry open the doors to financial independence years ahead of schedule. Your freedom is within reach. So, what are you waiting for? Stop thinking of your 401k match as just a little extra. Start seeing it for what it truly is, your fastest, most direct route to financial independence, directly powered by your employer. Take action today. Log into your 401k portal, check your contribution rate, and make sure you're getting every single dollar of that match. It's the simplest, most impactful financial decision you can make right now. Your future self will thank you for seizing this incredible opportunity to accelerate your journey to lasting freedom.